Hi everyone, my name is Marcus Anthony and welcome to my YouTube channel. Today we're going to be talking about ETFs, which are considered exchange traded funds. Now someone mentioned in the comments on one of my earlier videos that they want to learn more about what ETFs are and which ETFs could be well suited for them, so they can utilize these ETFs for their retirement. So before we get into the video, if you guys can just leave a like real quick, that'd be very helpful for me and for these videos to get out to as many people as they can. If you have any more questions or any topics that you want me to talk about in the future, go ahead and leave a comment down below. And then if you like what you see and you want to see more of my content, go ahead and hit subscribe and I'll come out with videos twice a week. So without further ado, let's get into talking about ETFs. You can think of an ETF as like a basket. And in the basket is a bunch of different fruits, which are different companies. So you could have like an apple, which could coincidentally be Apple. Yeah, I planned that out. You could have a banana for like Microsoft, orange for like Google, just a bunch of different fruits in this one basket. And that's what ETF is. It's just one investment that has a piece of a bunch of different companies. Let's say 100% of this ETF, you have 100%. 0.2% is Apple. They have amount of money that accounts for 0.2% being invested in Apple, 0.2% in Google, 0.2% in Microsoft, 0.2% in Tesla, 0.2% in Zoom. Just that tiny amount of money in every single stock, and that is in the S&P 500. So that means that if the S&P 500 goes down and goes to zero, your money will go to zero. But how the S&P 500 works is some companies fall out of the S&P 500 and some go in the S&P 500. Now you might be thinking, oh, well, how would you be able to track that if you have to worry about the different stocks and if they qualify or not for the S&P 500? You don't. A VT Sax, you just invest in the VT Sax and that automatically changes its holdings based on what's in the S&P 500. If a company falls out, they're no longer investing in that company. They're investing in the company that is now in the S&P 500. So you can never, in my opinion, it's a foolproof way to have your investments and not have it suffer too greatly. Now there will be some times when the S&P 500 drops like 40% like it did in 2008, 2009 during the Great Recession. But overall, it's pretty safe, and it's not going to give you a ton of a return, but it will give you consistently 7% on average year after year. It's just historically been proven to be that way for the past 60, 70 years. So now I'll show you some examples of some ETFs and how to read some of the financials and some of the important information when you're looking for ETFs to invest in. All right, so here we have an example of iShares, and this is just a bunch of ETFs that iShares has to offer. And so I'm just going to go through some and show you, what to look for when you're trying to figure out which ETFs to invest in. Here we have all of these ETFs. Now, it might seem like a lot to begin with, but it really isn't too bad if you know what you're looking at. So this kind of gives you some really easy data to look at. But so let's dive in deep for this one. This is an S&P 500 ETF where it has a bunch of every company in the S&P 500, but it has different percentage amounts of each company in the fund. So as you can see here, the price of this ETF is $335.89, and some are a little smaller, but for the most part, if you're going to be investing in these, it's going to be around this much. So it shows you their, total return as of August 7th, 2020. So if you dig in deep here, it shows total return amount over 1 year, 3 years, 5 years, and 10 years, and also since the inception of the ETF, because they didn't all automatically start. Some of them started 30 years ago, some started 5 years ago. It all depends on the company and how and when they started it. So what's really cool about this is you can go to this chart right here, and it shows you if you invested 10 grand, how much it would return over the course of a time period. So for example, let's just go over the course of a year, what that would look like. So, as you can see, this is over the course of just a year. You can see, okay, that's about where we were headed, and then the pandemic hit, and oh, look at that, it's all the way down to this much. So your 10,000 at this point is worth 7,800, which isn't that great, but still, it went down 20% during this pandemic, which is pretty much on par with every single stock at that point. But as you can see, as bad as the pandemic is, it bounced back, and that's pretty much the moral of the story as far as the stock market goes. Overall, the stock market is going to go down, and it will go back up. That's just how it works. So as you can see right now, if you invested 10 grand, even right before the pandemic hit, you'd be up 11 or 1,800 bucks. So over the course of 10 years, over the course of, if it would load, over the course of the entirety of this ETF, it started at 10 grand, and this is where it is now, at 34 grand. Over the course of, that's almost 20 years. So, this is a snapshot of the stock market, essentially. So you can expect something like that in your investments when you're saving up for retiring. So as you can see here, it shows the volume, the median, a bunch of stuff that you don't really need. The average investor isn't really going to be paying attention to. I don't pay attention to this stuff. What I do pay attention to, though, is the fees. Fees are extremely important. If you're ever investing in any type of ETF, there will be fees involved. A mutual fund, there will be even more fees. But the thing with a mutual fund is it's actively managed. So every day there's going to be investors that are buying more shares of different companies and mutual fund to make sure it is doing well and thriving. Where ETFs, it's just kind of like a set it and forget it type thing. But as you can see, a 0.03%, that's like one of the lowest you can get. So this has very low expense ratios. Now, and one more thing about expense ratios is if you're hiring someone to manage your finances for you, that 0.03%, first off, they're going to probably be investing in mutual funds, so it's going to be higher. And then you tack on another 1% or maybe even higher for the actively, because they're managing your money for you, even though they might not be doing a whole lot. But they're going to charge you quite a bit, and that could go straight into your retirement and the growth. So right here is what I was talking about earlier, where this is the holdings. All of these companies, this ETF has a part of every single company, and it shows right here what the weight is. That's how much of this entire ETF that's where it's going. So let's say you bought one share. Like we said before, this one's 335 bucks. That means 6.68% of 335 bucks, that's going into Apple. 5.9%, that's going into Microsoft, Amazon, Facebook, all these companies so you can see where your money is going. So, as you can see, the top 5 companies, quick math, that's around 20% of the entire ETF is going towards these top 5 companies. But as you can get lower, 1.18% goes into Procter & Gamble. So, just to prove to you, so on the 5th page, you're still getting a lot of good stocks. Broadcom, Nike, Qualcomm, a whole bunch of different sectors, which is right here. And 0.45% is going to Qualcomm, 0.45% is going to Nike, 0.44 Texas Instrument. So as you get further down the pages, you can see, okay, there's less and less going to these other companies, but for the most part, you're investing in high quality companies because they're all in the S&P 500. So now here we are. We're back to all the different funds you can choose from. And with iShares is this way, and I'm sure a bunch of other ones are this way as well. I know Vanguard is, but you can filter based on the markets and regions. So You could change whether if you want a China ETF or like a Belgium one or what have you. You can also change by a sub-asset class where you can invest in large cap companies, mid cap, small cap. So let's just do large mid cap for this filter real quick. So here we have some large cap. So most of these companies are going to be large or mid cap that you can invest in. And as you can see right here, you have different expense ratios. So these are going to be more expensive to get into, but especially 0.68, that's pretty high, but that's emerging markets. So it's a different ETF. But so let's see here, you can invest in, let's go into this one, this growth ETF. That's a 0.4 expense ratio, which is really high. And before you invest in one of these that's really high, I would highly recommend really diving deep into it. So this one's kind of interesting. So you have, it's $87 to get into, which is not bad at all. And so the year growth is for this year's 2%, but again, that's with the pandemic, so I have to take that with a grain of salt. So this is the growth over the course of 10 years and everything like we saw before. And we'll look at the full chart again. So this, notice right here, it says 2005. This investment is only, or this ETF is only 15 years old. So you start with 10 grand, and now if you invested as soon as it started, now you're up to 22 grand over the course of 15 years. Again, it's not as high as the other one, but it's still higher than what you got. As long as you're not losing money, it's a win, right? So we're going down, key facts, yeah. Fees, again, 0.4%, that's pretty high. That other one is 0.03%. That's like a 13th of what this one costs. It can add up pretty quickly. Now let's talk about the holdings here. Yeah, this is interesting. So, your typical Apple, the big companies, they're not in this ETF. Or if they are, this ETF has a lower holdings of them, but Nestle is the highest holdings at 5%. Roche Holding, and again, the different sectors. You can get, and I'm just going through these two ETFs right now, but you can get ETFs that focus on sectors. So you could get an ETF that is like only healthcare companies are in this ETF, or only financial companies or consumer supplies or anything like that. You could get an ETF for each specific, industry that you want. And so like you see, so this one has only 47 pages. So this one has less of a diverse investment pool than the other one that I showed you. But yeah, you can go through all, there's Sony, there's a bunch of ones I've never heard of before, to be honest, but they're in there for a reason. So if you are looking for an ETF to invest in, I highly recommend three things. Looking at the chart and seeing where that money has gone. Has it been going up? Has it been consistent? Has it been dipping down when the stock market falls? What is the behavior of it? Is it dipping down for no reason and there wasn't like a pandemic or a recession happening? Because if it is, that might be a red flag, and that might mean it's a little bit inconsistent, which means it's a little more risky. The ones that I showed you right here, they're more consistent, where you can kind of predict, oh, okay, it should be dropping here because there's a pandemic. Okay, yeah, it dropped here. So it's relatively consistent, and it's stable enough where it's not gonna randomly drop out on you without you knowing. So looking at the chart, that's number one. Number two, looking at expense ratio. You have to be aware of how much you have to spend to get into one of these ETFs. And number three, looking at what companies it holds. It's important because you don't want to buy an ETF that is focusing on medical companies when you really want to get one that has one focused on consumer supplies. So you want to be aware of what you're actually investing in for your retirement. So anyway, I just wanted to show this to you guys to see what I look for when it comes to looking at ETFs to invest in. So anyway, that is my video on ETFs, and I hope you liked it, and I hope you find it enjoyable. So If you like what you saw, go ahead and give a like real quick. It'll take half a second, I promise. And if you have any additional questions about ETFs, go ahead and leave them down below. And if you want to see more of my content in the future, go ahead and subscribe on your way out, and I'd really greatly appreciate it. So thank you so much for watching, and I'll catch you on the next one.